It's a pleasure to be joined once again by Bob Deitrick, co-owner of our great sponsor Polaris Financial Partners in Columbus, Ohio, also co-author of Bulls, Bears, and the Ballot Box. Bob, Forbes has been doing a really good job of covering what have been your correct predictions in terms of what would happen to the economy under a President Obama presidency, in part based on what's happened under other Democratic presidents in the past. So let's start broad and then narrow down. To evaluate how the economy is doing, what metrics should we be paying most attention to?
Well, first of all, David, thank you very much for having us on again. I greatly appreciate it, and it's a pleasure to be on your show with your guests, with your audience again. The primary metrics that we're looking at that from a macroeconomic standpoint, David, are unemployment, and we're going to see another unemployment number come out this Friday, which will be a little bit interesting because the market will be closed on Good Friday too. But unemployment is one of the key ones we're focusing on. GDP, manufacturing, service, all these different factors from a macroeconomic standpoint we're looking at to see whether or not the economy is improving. And it is. We've seen some very strong fundamental improvement in the economy over the last 6 years.
And let's talk a little bit about the stock market specifically. And as most of our audience knows and has heard me say, the stock market by itself is not the best indicator of how the economy is doing overall, particularly when we consider the concentration of stock ownership disproportionately amongst the wealthiest Americans. But it does tell us a lot about the confidence that different players have within the economy. So let's start with the numbers. We've had quite a remarkable run-up, have we not?
We really have, David. Since March of 2009, which was the bottom of the trough of this last cycle, the market is up between 300 and almost 400%, depending upon the index you look at. In fact, some of the indices on the mid-cap and the small-cap indices, like the Russell 2000 and the S&P 400, are up between 350 and 380%, which is pretty remarkable. In fact, this is the best rally we've had in the stock market in the last 85 years, including the rallies we had in the Reagan years in the mid-'80s and the Clinton years in the latter part of the '90s.
And very often we hear from the detractors of Democratic presidents or presidents who are more supportive of demand-side economic policy than supply-side, that the great performance, that if we can get them to admit that there has been great performance under a Democratic president, they will often say that this is because of what they describe as sort of the lag time, or the idea that the policies enacted by a supply-sider, a Republican president, take some amount of time to really take effect. You've studied this in detail. Is there anything to that?
With all due respect to them, that's total nonsense. And the notion that somehow that the things that George W. Bush did 6 or 7 or 8 or 9 years ago, or that we did when he first entered into office in 2001, are having an impact today is ridiculous. Quite frankly, the reality is this: if a Mitt Romney or a John McCain were in office today, I guarantee you they'd be taking every bit of credit for what's happened in this market. But unfortunately, when President Obama tries to take any credit for anything, they make him out to be arrogant or pretentious, or which is just ridiculous. The reality is, every president should stand on what happens during his watch, or hopefully someday what happens on her watch, if we get a Hillary Clinton elected in 2016. And they are the CEO of the country, and what happens they're responsible for what happens on their watch. Yes, there are some indiscriminate lag times, but they're not 5 and 6 years. They're maybe 6 months to a year. And the reality is what President Obama has done in the last 6 years is pretty remarkable, given where we started in in January of 2009 when he came into office.
What's your sense in terms of how long this run-up can be expected to continue? With regard to jobs, on the one hand, we've seen many consecutive months of 200,000 plus new non-farm jobs. I don't know offhand whether it's some kind of record, but it's been quite a run there. It is a record. It is a record. We've seen significant run-up of the stock market. Ultimately, there are corrections, and aside from discussing this from a sort of market timing perspective, what will it mean if and when, or more likely when, there is a slowdown in terms of jobs or the stock market?
Well, we're not seeing any sense of a slowdown presently. In fact, the reality is the economy is really improving, and it's done so in a very organic way, pretty much on its own, without the help that we generally would have from Congress or from the White House. Generally, we would have some sort of infrastructure bill that would be designed to help the economy along, but we haven't had any help at all from Congress in the last 5 or 6 years in that respect. So what's happened has been pretty much organic, which is why I think that this rally is going to last longer than some of the other rallies have in the past. This slow, methodical, gradual crawl out of a very deep hole that we got ourselves into is, in my view, the way out, as opposed to what happened during the Reagan years, as that you might recall, where the market had a huge run-up between 82 and 87, and then a big crash that followed that in October of 87. I think that this rally, I know we're in the 6th year of what we think is going to be a 9 to 12 year bull market cycle. So I don't think I think we're somewhere in the 3rd quarter, if you will, of this cycle.
Do you believe then, if so here's where I start to wonder about the impact of the next president. When Mitt Romney was running against President Obama in 2012, they each were making different promises and predictions about what would happen under each of their watches if they were to be reelected or elected for the first time for Mitt Romney. However, economic indicators did suggest that in the immediate aftermath of that election, jobs were going to continue being created and generally things were going to be okay. So to some extent, we know that there are significant differences between Republicans and Democrats in the White House. At the same time, though, sometimes we do see some inevitability. Do you see that 9 to 12 year bull market as inevitable, regardless of who the next president is?
That's a good question. I think that, again, our studies have shown that Democratic presidents have been better stewards of our economy. And when I say that, I mean that they have been better at creating more consistent, more predictable, and more stable growth. Whereas when we've had Republican presidents, whether it be Hoover going back or Coolidge going back quite a long time, or Reagan or George W. Bush, what we see is more boom and then followed by great bust. And I think that most Americans don't want that. They would like to have the consistency of knowing that a cycle is going to last more than 4 or 5 years, that in fact it could last 8 or 9 or 10. And I think that that's what's going to happen in this cycle. Going back to your question, though, I think that the probability of a Republican being elected in 2016, with all due respect now, with those that they're putting up so far, is pretty remote. But I guess we'll see what happens next year.
Yeah, it's still very, very early. Certainly Ted Cruz does not seem to be the guy that is going to be the president. Let's play devil's advocate on a couple of different things. You said for the most part, this has been a sort of organic run-up. However, we still have what some would consider artificially low interest rates, and this is impacting both banks taking out loans with which they can then loan out more money, as well as mortgage interest rates, etc. Is that not an example of a slightly artificial component to the current economic status quo?
Well, keep in mind that if you take a look at the 10-year Treasury, which today is right around in the United States around 1.93, 1.94%, and it was as high as 3% not too long ago.
Right.
Again, the reality is, if you take a look at the 10-year note in other countries, whether we're looking at Germany, France, Great Britain, Japan, we are higher than almost every single industrialized country in the world. So the pressure for us to raise rates is really not that high, when in fact the reality is most foreign investors can get a very attractive rate here in the United States relative to where they are in their own countries. So there's just, as long as the rest of the world is growing at this modest pace, I don't think there's a lot of pressure on interest rates going up dramatically.
And last thing, and this is really one of the most important elements of this recovery now, which is that although wages have started to trickle up, wage growth is certainly lagging other economic indicators. And this is a common thing in early years of an economic recovery. Whether we're still in the early part of this economic recovery is starting to become a little bit dubious. What's your thought on this wage lag that we're seeing?
Good question. I think that, again, keep in mind that the stock market is always a leading indicator of where the economy is heading. Unemployment or employment and wages are a lagging indicator. So we think that wages will follow, that we are beginning to see some growth in wages here in the last couple of months. But the reality is what we really do need, and something we have had in some states, is we do need an increase in the minimum wage. That would force all businesses to increase wages, which would be good, I think, across the board for the entire country. But again, this Congress has been very reluctant to even touch any increase in the minimum wage. and that probably isn't, we're not going to see anything there, I don't think, until at least 2016 or 2017, I should say.
Well, without question, we're going to continue following all of these stories. We've been speaking with Bob Deitrick from Polaris Financial Partners. PolarisFinancial.net is the website. And check out the book, Bulls, Bears, and the Ballot Box. It really kind of gives you a lot of the foundation for this thinking around party, presidential party, and the economy. Bob, thanks so much for being on with us again.
Dave, it was a pleasure to be with you once again. Thanks so much for having us.